Hi, I wanted to record this quick video to talk about structured notes. Really cover a couple of things. Number one, on a high level, what are they? How do they work? And are they right for you? So just a little bit of background about myself. My name is Richard Ehrlich. I'm the president and founder of the Secure Wealth Planning Group. I've been helping clients make informed decisions with investment and retirement planning for over 20 years. My background is a certified financial fiduciary, which basically means that I am product and investment agnostic. And really, we're focused solely on each client's specific goals and objectives. So the standard disclosures, this is a high-level educational video. It's meant to give you some background into the space of secured notes. Obviously, every case is designed specifically for people's individual financial situations. And certainly the examples we're going to show today are just examples. Okay, so the number one question we get all the time after people learn about them is, how come I haven't heard of these before? Well, traditionally, the structured notes were minimums of very, very high investment dollars, minimums of $1 million or more. They were typically only available to the very high net worth community. But now, like everything else, through advances in technology, we're able to break these notes down into smaller components for more people to take advantage of them. So really, what are structured notes? Well, it's pretty simple. They're really they're bonds in essence. 80% coupon. It's an 80% bond married with or coupled with a derivatives package, which really is a fancy word for insurance on certain securities. And really, it's a hybrid security. These notes are issued by major banks such as J.P. Morgan, Citigroup, just to name a few. So, perspective, how big is this market? This slide talks about several different asset classes: commodities, real estate. Commodities have a global assets under management of about $319 billion in the last couple of years. Structured notes is $2 trillion and rising, so a very, very substantial global market for them. So every note has really four simple parameters for the most part. And really what the note is it's this bond component I was describing, but they're linked to the price and the return of, it could be, as this shows here, stocks, ETFs, many different investments, obviously excluding the dividends. And really what's happening is whatever we'll take a look at it, a few examples in a minute, but as long as the price of those securities or whatever underlying asset does not go down, as it shows here, protection below this buffer or protection doesn't make a difference. As long as it doesn't go below that number, the investor still gets their coupon or their interest. They all have a maturity date. They can range between 6 months and 20 years. Most of them are within 3 to 5 years. And then, of course, there's a payoff of whatever that's going to be, depending on the note, at the end of the maturity. And, of course, these are all highly, highly customizable. The primary draw of these structured notes is the fact that most people already have exposure to these types of stocks or asset classes, but now we're able to partake in them, get a competitive rate of return with having downside protection. Also, one of the people always ask is how are these notes held? We set up accounts with major custodians, Charles Schwab being one of them. Let's take a look at some examples. This is a note that is tied to, as you can see, to Apple, Goldman Sachs, and Tesla. Now, this one has a 30% coupon protection and a 30% soft principal protection. What that really means is that what the coupon or the rate of return of this note has, they take a look at these three stocks, and the lowest performing one, and this happens to be a monthly payable coupon, they look every 30 days at an observation date, so every 30 days, and they say, hey, where are these stocks? And as long as one of them is not down by more than 30%, the investor will receive their interest for that month. The 30% principal protection, that says at the end of this term of the note, which is 36 months in this case, as long as one of those securities, Apple, Goldman Sachs, or Tesla, are not down more than 30% from the day that it was purchased, then the investor will get their full principal back. There's different ways that you can structure them. So this particular note has an annual coupon of 34.92% annually. As you can see on this chart, based upon 36-month rolling time periods since 2013, it's only breached the 30% mark one time, and that was during COVID. Okay, let's take a look at another note. This is a note that is tied to the insurance company Voya, Costco, and Goldman Sachs. This also has a 30% downside protection for coupon protection and also a 30% soft principal protection, same 36-month term, but these have different stocks in them. The annual coupon on this paid out divided over 12 monthly is 16.44%. As I said, this is meant to give you an overview of what these types of notes are, how they possibly can be used. As I said, most people already have exposure to these types of stocks or these types of risks, and this is just one way to take advantage of the market and have downside protection. If you would like to learn more about these types of notes, how they could be a good fit for your overall portfolio, we can be contacted by phone. We do tons of Zoom meetings with people all over the country, or in one of our offices, our main office here in Boca Raton. Obviously, give me a call. You could send me an email at re@securedwpg.com. I want to thank you very much. I look forward to speaking to you soon. Take care.